This time around, the Fed will be cutting rates when we have an insolvent nation, and at the same time we have an inflation problem that hasn't been vanquished. I expect them to cut 3 times this year. That's my base case scenario. But the risk is that they have to go much more, and it's not because of a good thing. It's because that the liquidity, the fuel behind these asset bubbles has been cut off. The United States is supposed to be a free market economy, and when you hear things like the idea is that, well, we can never have a bear market in stocks, and you can never have home prices fall, and you can never have asset prices fall, you can never have a credit bubble burst in any way at all, and banks can't fail, businesses can't fail. I mean, it's a czarist, communist kind of regime. I think if they do it again, if they pursue ZIRP, zero interest rate policies, if they blow up the Fed's balance sheet again, QE, printing trillions of dollars, they launch another round of helicopter money. Stephen, what's the excuse if they go back to zero now? I think they're out. I think the ruse is up. That's what the Fed has inculcated to people, to investors over the decades. Hey, we got your back. We got the Fed put. We're never going to let the market fall too far because we got your back. Okay. Let's see how well that works.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Michael Pento. He is the founder and president of Pinto Portfolio Strategies. Michael is an industry veteran, having worked in the investing field for a long time, and I'm really looking forward to hearing his thoughts overall on the market. Welcome to the podcast, Michael. How are you today?
Going well, Stephen. How are you?
Yeah, I'm really good, thank you. Really good, thanks. So I'm really happy to welcome you on the podcast today. It's really great to have you on. I find your views very refreshing on the markets because when you put across your points, they're very precise and you look over the whole macro picture. So real pleasure to have you on.
Thank you.
So just to get started today, I would like to ask you if you could please lay out your macro picture of what you think's happening in the markets at the moment and the way that you see things moving forward.
Well, it's going to take me a while, but it's a good question to start with. So I have a 5-sector spectrum when I ask myself and my investors, where should we put our money right now? So I ask myself, the first question is, the all-important question is, what is inflation doing? Because you can make money in stasis inflation or reflation. You can make money in hyperinflation in nominal terms. You get killed in real terms. But the most salient question to ask is, what's inflation doing? Because you can't make money when you're in deflation. Deflation, usually in a fiat currency system, runs concomitant with recession and depression. So you have to understand where you are there. And if you're in disinflation, you have the ability to make money, but it's harder. And there's certain things you can't own. You can't own high volatility investments. You can't own Bitcoin. You can't own NVIDIA, small cap stocks, for example. You want to have more in the bond and bond proxies. And disinflation is sector 2, and that's where we are right now, according to my model. There is a significant risk we could be in sector 1, which is deflation and recession or even depression, because that's really where the market should be heading. And I say that not flippantly or garrulously. I say it because that's where I think asset prices need to go. They have to go down 40% around that level, if you think of equities and real estate, to put them in balance to where they've been historically speaking. And that's just in balance, not at a discount, not at a great bargain, just more in line with where they traded historically in the metrics of GDP and incomes. So that's where we should be. I highly doubt we're going to get there without a fight, because you see what happened with the Bank of Japan Governor Ueda and his crew recently. So, I mean, they were talking tough. We're going to raise interest rates, and we're going to get them. They were negative for like 15 years. They moved them to 0, and then they finally moved them to 1/4 of 1% and that caused the end of the yen carry trade and caused the Japanese Nikkei Dow to drop 12% in one day. And at the end of the day, central bankers don't want reality. They don't want positive real interest rates. They don't want a normal economy. They want to do whatever they can to keep asset bubbles afloat and banks in business and doing great. That's what that's their real charge is. So they started walking back their comments about being able to raise interest rates any more than 1/4 of 1%, which I think is ridiculous. It's absolutely ridiculous. You know what else I find ridiculous too? And sort of a comedy act is that the soft landing crowd, the soft landing mantra on mainstream financial media. That's all they've been saying for months and months and months, that we're going to have a soft landing in the economy. Ever since the Fed went off off of zero, now they're 5.33% on the Fed funds rate, and we still had the soft landing crowd. And up until like a week ago, we were going to have a soft landing in the economy. But now that soft landing crowd is saying we need to have panic rate cuts. Panic, emergency, multiple 50 basis point rate cuts in a series of them. And why was that? Was it because the economy went into meltdown mode? No, not really. It's because inflation crashed to deflation and home prices are down 20%. No, that's not it. It's because the stock market had a bad week. So, so it's kind of a buffoonery here. So, and to Jay Powell's credit, he didn't blink yet. He'll blink, I'm sure, but he just didn't blink yet. So, the long answer to your question is that we are in disinflation in the context of a slowing economy, and investors should be in the market, but they have to be adequately invested in the right sectors and style factors, and not just hold Nvidia and hope that they can make 100% every few weeks.
Yeah. Apparently, the markets can only go up, they can't go down, which is why we've seen that panic crowd over the last week or so.
Well, it's just disgusting. We used to have a free market economy. The United States is supposed to be a free market economy. And when you hear things like, the idea is that, well, we can never have a bear market in stocks, and you can never have home prices fall, and you can never have asset prices fall. You can never have a credit bubble burst in any way at all. And banks can't fail, businesses can't fail. I mean, it's just like, it's a czarist, communist kind of regime. And I'm afraid, politically speaking, we don't have much hope if we have one side of the ledger here is talking about, the United States. I'm not political. I'm a libertarian, so I don't like either candidate greatly, but I'm one of them, which is a vice president right now, said that she wants to guarantee equal outcomes. Not that you want to treat everybody. The United States is about having a level playing field where everybody can succeed. She said that she wanted to give everybody the same amount of money. She didn't say that. She said she wanted to give more money to certain people so it can guarantee an egalitarian socialism outcome on the other end. So it's not just markets that are deprived of market forces. It's not just supply and demand forces. It's the economy in general now that we have outcomes of, everybody's going to be the same, but the level is going to be much lower. And that's why you see, the middle class of this country has been eviscerated, and I don't see any hope for them in the short term.
I wanted to ask you more about that, actually. Obviously, you mentioned just then, and I've heard you mention it before, about the bottom deciles of the population in the US having economic troubles and all of the money kind of floating up to the top percentage of wealth earners. How do you think that plays out over the long term? How do you think that real disparity between the world's wealthiest and the people that are just trying to get by in everyday life, how will that play out long term in the economy?
Well, I mean, historically speaking, it doesn't end well for a country. You can't have a viable country, a prosperous country, without a viable and healthy middle class. They're the ones that do all the work. They're the ones that actually make things and do things. The poorest among us tend to live off government stipends, and the very rich live off passive income from real estate and dividend income. So it's the middle, the large middle. So you think about the second, third, and the fourth quintile. 20% to 80%, they're the ones that actually go to work every day and produce things and make things. And if they can't make it anymore, if they just drop out because going to work and paying for the gas to get there just doesn't make, they can't eat. It's better. In other words, if it's better for them just to go on the government dole, then that's what happens. And you have no production. So it leads to stagflation and dysfunction and civil unrest. That's the nature, that's the history behind what happens when you eviscerate the middle class. And that's what we've done. And like I said, I mean, and if I'm hearing, what I'm hearing now is, well, we're going to have to get emergency rate cuts. What is that going to do to that bifurcation of the economy where you see the top 1% who own multiple houses and who have a large stock portfolio vis-a-vis those who rent and those who have menial service sector jobs? What do you think it's going to do to their standard of living? It's just going to make that yawning gap even wider.
Yeah. Yeah, I agree with you. I think it'll make the gap much wider. And I think some of those job numbers are a little bit skewed as well, because I think a lot of people are not registering as unemployed because maybe they're doing temporary or part-time work where they're not in their overall careers.
The number of full-time employees is negative. If you look at the household survey, we're not creating many jobs at all over the past year. So it's a very dysfunctional labor market. And I think, and I look at the initial jobless claims, and you look at the unemployment rate, it's getting worse. This is the first salvo of what I see a series of very weak data coming out. And of course, what happens is the mainstream financial media and the economists and market strategists would just dismiss it all away. I'm hearing it's noise, it's seasonally adjusted. I mean, yeah, it's seasonally adjusted. They always seasonally adjust the numbers. So sometimes they add to the numbers and sometimes they subtract to the numbers of unemployment claims. That's called the seasonal adjustment. So you can't just overlook seasonal adjustments. There's plenty of evidence that shows the labor market is weakening. If you look at part-time, full-time employment, if you look at the unemployment rate, look at the number of job layoff announcements from Challenger, Gray, and Christmas. If you look at the ISM manufacturing survey, which shows a plunge in employment. So yes, the labor market is weakening, and you'll see the mainstream financial media excuse what's happening all the way through until it's too late and they can't, and then they start begging for the Fed to come to the rescue. But here's the thing. Here's the punchline, Stephen. This time around, the Fed will be cutting rates when we have an insolvent nation and at the same time we have an inflation problem that hasn't been vanquished. So there's a very good possibility that this time when they cut rates, the 10-year note and up, so you go out along the yield curve in duration, that usually falls in yield. So price goes up, yield falls, and that's not probably what's going to happen this time. You'll see a very sticky duration. Convexity will be much higher, and you'll see, I believe, rates rising, possibly even significantly, the next time we pursue inflation to bail out the economy.
How do you see the interest rates cuts going over the next kind of 1 year? Do you expect them to cut aggressively coming into towards the end of 2024 into 2025? Or do you think it's going to be more of a gradual process, kind of look and see how inflation's going? How do you see them playing that out?
Well, I see that. I think you'll get the 25 basis point cut in September. And I think you probably will get one or two more. So it's 75 basis points. By the way, Stephen, that's already fully priced into the bond market. And if you look at the spread between the Fed funds rate 5.3% and say the 10-year note at 4, I mean they're already priced in 125 to 150 basis points, already fully priced in. It's priced into the mortgage market, it's priced into the bond market. So the Fed will just be fulfilling that path that's already been laid out by the private market. So the caveat here, and I expect them to cut 3 times this year. That's my base case scenario. But the risk is that they have to go much more. And it's not because of a good thing. It's because that the liquidity, the fuel behind these asset bubbles has been cut off. It's almost completely gone. So if you look at the level of the real Fed funds rate, it's at 2.3% now. It's been positive for over a year. If you look back over the last 21 years, it's almost been negative every single year except for a handful of years. So say 18 out of the last 20 years. And sometimes The negative real Fed funds rate has been minus 8%. So if you look at the Fed funds rate minus inflation, it was 8-9%, minus 9%. So it was like, I have to borrow. So when nominal rates and real rates are that low, people borrow money and just put it somewhere, buy a house, buy a commodity, and you're almost guaranteed to make money because inflation is higher than the cost of the funds you borrowed from. And that's not the case anymore. So you have an inverted yield curve. Banks are reluctant to lend because they have that inverted yield curve. Banks have tightened lending standards. Although they've eased lately, they're still in net tightening. And you have the reverse repo facility, which is almost dry. It was $2.5 trillion. Now it's just $280 billion in the reverse repo facility. That's the excess reserves in the banking system, which was used to buy all this government debt, $2 trillion deficits, $1 trillion in interest. So we're very close to liquidity running out here. The Fed's balance sheet continues to shrink from $9 trillion to $7 trillion. That's high powered. It's also called high powered money for a reason because it's the base of all money creation. So yeah, we got some problems here in liquidity. And what you need to keep asset bubbles inflated is that liquidity. It's just gone, and it's evaporating very quickly. It's almost gone. So there's a very big risk that the Fed will have to come in, and you'll see more days like we had last week where you see credit markets freeze. That's what believe me when I tell you this. I've been doing this 33 years. The Fed plays a tough game. We're fighting inflation, but they're not there for Main Street. They're there for Wall Street. They're there to protect banks because they say, well, banks go under, then Main Street's dead too. That's their excuse. And they will aggressively cut interest rates. And I think it'll be in a panic reaction in arrears to a faltering economy.
Do you think that they can play the same old dance of reducing the interest rates and getting them really low back down to kind of the levels that they were during COVID, kind of zero interest rate? Do you think that they can do that, considering probably what it would do to inflation? Because it's a very different economy to what it was when it was there previously.
I think if they do it again, if they pursue ZIRP, zero interest rate policies, if they blow up the Fed's balance sheet again, QE, printing trillions of dollars, they launch another round of helicopter money, the game's over. Because, think about this, Stephen. The first time they did this was in 2002 to 2004. Is when they went to 1% because the NASDAQ bubble burst. Then they went to zero because of a once-in-a-lifetime global financial crisis, because how bad the banks behaved that time. And then they went back to zero again. Oh, they were on their way there anyway. But it was a once-in-a-lifetime, once-in-a-1,000-year or 100-year, whatever you want to say, pandemic. Stephen, what's the excuse if they go back to zero now? I think they're out. I think the ruse is up. People won't say, listen, the Fed can never raise interest rates to a level that kills asset bubbles. We are stuck in this, treadmill of never-ending inflation. They can't fight it adequately without destroying the economy. And I think inflation doesn't stop at 9% the way they count. I think it goes to way into the double digits, if that's the case. And so if that's the case, and everybody knows it, they should know it, then the remediation process, which normally involves taking interest rates down across the yield curve, that doesn't happen. The Fed only controls the overnight lending rate and money market rates, which is short-term lending. They do not control directly long-term interest rates. And I think they react very negatively. So I think one of the things that's going to happen is a blowout in the yield curve, which it's not only it's been inverted for the longest period in history, one of the steepest inversions and the longest inversion in history. That, by the way, that never ends well. The only time since 1955, only one time it didn't yield a recession. That was 1965. Oh, that's when GDP crashed from 10% to almost zero. So it always is correct. The yield curve is correct, but I think this time we're going to have the recession, but the yield curve is going to uninvert or revert, whatever, or normalize, whatever you want to say. And the difference is going to be enormous between long-term rates and short-term rates. So you're going to have massive increase in money supply and a huge increase in inflation, a dysfunctional middle class, stagflation as far as the eye can see. That's the most likely outcome that I see right now. But I'm not investing for that now. I'm investing for what works now, which is disinflation.
Yeah. I was going to ask you that as well. Can you explain a bit more about your model? I think you call it the inflation deflation economic cycle model. Can you just explain a bit more about that, but also explain where you think we are in that model at this current time?
So we are in sector two. As I indicated, it's disinflation. The sector, I asked myself where we are in the five sectors of inflation between deflation, disinflation, stasis, reflation, and intractable inflation. And then I asked myself a further question: what's the economy doing in the context of that inflation? Are we in a recession, or are we growing? Is the economy growing? So I have a 20-point model, lets me know exactly where we are in inflation terms and exactly where we are and where we're headed over the next few months in both inflation and economic growth. And then I asked myself one further question: is in this context of inflation deflation, what's the level of the asset bubbles? I mean, do we have an asset bubble or do we not have an asset bubble? Because that lets me know how dangerous the recession could actually be if we're indeed heading into one. And then, as I said, we're in sector two. We should be in sector one in the next few months or quarters. And then from there, I think we can go to sector four and five very quickly, which is stagflation, in reflation and then stagflation very quickly, unfortunately, for the middle class of this country. And every sector, by the way, so I have the model, I have the sectors. Every sector has its own, every bucket or sector has its own individual stocks, bonds, currencies, commodities, style factors, sectors that you should own. So right now, like I said, sector two is more bond than bond proxy. Sector one is one of, again, deflation and recession. That's the four horsemen of the economic apocalypse. That's when you really want to own short-term bonds, short-term government bonds, have lots of cash. You should own the U.S. dollar then, not now, but then you want to own the dollar. And you want to be able to short the market because those are the only things going to work. That and maybe possibly also that yield curve expander. But you have to get the timing right. I mean, I'm certainly not perfect, but it's better than saying, hey, just buy and hold stocks. I mean, look at 2022. You buy and hold stocks and bonds, and you got destroyed. You lost 22% in stocks, and you lost like 50% in bonds, treasury bonds, not garbage. And I think you say, okay, well, let me just keep my portfolio. Well, what do you want to own in sector five, which is stagflation? Well, you don't want to own bond and bond proxies. You want to be short bonds. You want to be out of bonds, and you want to be long base metals, energy, commodities, rather than be long utilities and, say, housing stocks. So it changes based on the sector. And so bond and bond proxies right now, you want to be long utilities. You want to be long treasury bonds. So that's how I think about managing money. I mean, isn't that better than saying, well, just buy the S&P 500 and try, or what most of Wall Street does, they're just salespeople. They're just closet index the S&P 500 and say, buy and hold. Well, buy and hold it. Well, then what do I need? Let me ask you a question. If that's the case, if you're going to tell me just buy and hold this group of stocks that mirror the S&P 500, because that's what you want to do, as most people benchmark to. Well, what do I need you for? You just buy the SPY and sail off into the sunset. I mean, how much of the SPY do you want to own? How many foreign stocks you want to own? What kind of bonds do you want to own in your portfolio? That has to change, because if you have that static buy and hold portfolio, look, I just hearken to two places. Look at Japan since 1989. That nation, in nominal terms, that market, the Nikkei Dow, is still down from where it was in 1989. That's 35 years of not making any money. In fact, you're getting killed if you bought in 1989 in real terms. And if you look at the Shanghai Composite in China, that peaked in 2007. I think it's still down about 40% the last time I checked, from 2007. All right. Do math live on TV, but it's 17 years. That's a long time to be down 40% in your money. And there are times even in the United States, 1929 was a bad time to invest in the stock market. I think we're in one of those times right now. We resemble more of Japan in '89, where we have concurrently three bubbles that exist all at once: stocks, bonds, and credit. And if they burst, and there's no easy answer, no easy salve, you could be in a world of hurt just with your buy and hold strategy.
I think people have been really spoiled by the number of years the market's been going, up and up over the years. And I think a lot of people think, the average investor thinks, that they can just be very passive and just let things ride. But we all know that different times in history produce different results.
Just anecdotally speaking, when I talk to people, and you know what they say, they were saying about last week's um, carry trade reversal. For example, they said, just, you know what, stock market, they'll always get it right. They'll always say, just don't look at it. Don't look at it so often. That's what I'm hearing from people. That's what the Fed has inculcated to people, to investors over the decades. Hey, we got your back. We got the Fed put. We're never going to let the market fall too far because we've got your back. Okay. Let's see how well that works. By the way, Japan took interest rates. The Bank of Japan wasn't like, uh, they took interest rates. They didn't do, not like they didn't do anything. They owned almost every bond issued from Bank of Japan, bought almost every bond issued from the government, and they owned, I think, 60 or 7% of all bonds, 40% of all Japanese ETFs. So the interest rates were zero, or actually negative for like 15 years. So it's not like they didn't do anything. They did a lot. Didn't really help them. So do we want to be Japan or do we want to be Zimbabwe? I don't know. But people will laugh at that. But why do the laws of economics not apply to the United States? I mean, we do have the world's reserve currency. We do have the dollar. So I get it. We do have a very liquid bond market. I get it. But that didn't stop bond yields from going up to 15% in 1980, did it? So can we have a disaster in the bond market? Absolutely. And so I wouldn't be as quiescent and easily placated as most people think we should be.
Yeah. Okay. So for your own portfolio, are you trimming some of the risk in your portfolio during this period in your model?
Well, I have been. I've been doing it since May. So I've been unloading some longs in the portfolio. Still have a long position, but I've added some interest rate volatility hedges. I'm short junk bonds, but I don't have any direct shorts in the portfolio yet. I have some hedges, I'll say, but I'm still long the portfolio because you don't want to be listen. The market almost always goes up, so you got to be careful. You only want to short the market in one sector, and that's sector one. We're not there yet. We're not in. I don't think we're in a recession yet. I think we're headed there rather quickly, but I don't think we're in a recession yet. Deflation is when you want to be short stocks. We're not in deflation yet. We're in disinflation. So I'll try to get the timing as right as I possibly can. I'm not gonna move until my model tells me to move. And I might be a little early. I might even be a little late, but I'm not gonna sit there and hold stocks when they're down, 20, 30, 50%. I sit there and say, they always come back. Don't you know that?
All right, Michael, thanks very much for that. If anybody would like to find out more about you or find out more about Pento portfolio strategies, how would they get more information?
So the website is pentoport.com. And the email address here is mpento@pentoport.com. If you have a portfolio of $100,000 and you're a U.S. citizen, I'll directly manage your money in the IDEC strategy. And if you have $50, there's a podcast called the Midweek Reality Check, which I give you the 36,000 foot view of what's going on and tell you how I feel about the data of the previous week. And there's a 5-week free trial for that, and that's called the Midweek Reality Check. And both those, more information is available at the website, pentoport.com.
Okay, thanks very much, Michael. It's been a pleasure to have you on. I hope we can have you on again sometime in the future and we can go through a bit more in depth some other subjects. So thank you very much for your time and look forward to speaking to you soon.
Take care, Stephen. Thank you.
Okay, bye.